In today's video, we're going to analyse the current market and why the current optimism surrounding the US market specifically is actually incorrect, and what kind of assets you should be owning if you're an investor. Just as a warning, I am not a financial advisor, nor am I telling you what to do. Seek the help of a professional to tailor your investment strategy according to your risk tolerance. So, starting off, we can see in the US, we're beginning to see investors, firms and consumer confidence rise as they're under the impression that inflation has peaked and Fed fund rates will no longer need to rise much further, which in reality is much further from the truth. So in 2021 and 22, we saw a big trend of investors, especially in the latter half of 2022. Investors starting to become incredibly concerned across the globe about rising inflation, which of course is a concern, but there was this the markets and investors and institutions were all just capitulating and they were selling. But now investors are starting to see inflation slowing down. We're seeing disinflation, which essentially means the rate of inflation is falling as compared to what it was a year ago. But that still means inflation is still rising, but not as much as you would think. Now the reason for this is because the US specifically has actually altered the way they measure the CPI, which is the CPI, the Consumer Price Index, which is the basket of goods that they use to measure inflation, right? So essentially what that means is that they can now make it so that inflation looks lower than it actually is. And the way they do this is, previously the way they measured inflation was they would do it over a 2-year average period, whereas now they've lowered it over the following 12-month period, just to make it have just a little bit less inaccuracy, and they can alter it in certain different ways. They don't publicly come out and say, hey guys, look, we've altered the way in which we measure inflation, so be careful when you're comparing it to historical inflation figures because it's not going to be completely accurate. But they kind of put it in the footnotes of the press releases, right? It's like how in the UK we went from using the RPI, which is the Retail Price Index, and then suddenly started using the CPI in like the 2000s, right? And they don't even consider that when they look, inflation's at record level for 40 years. Well, no, if you're comparing like for like, the RPI, it's at a record. It's been since the 70s. The RPI was around 14-15% in the UK, whereas the CPI got to about 10%. Now, there was a recent report in which it showed the UK, out of all major economies, was actually going to contract, and even Russia was going to grow, which is very skeptical of those figures, because any kind of prediction, it's on mathematical models, and these models can be completely wrong. Okay, the actual reason why the UK has suffered so badly so far from the inflation issues, and we're contracting so much as compared to other major countries, isn't the fact that it's to do with Brexit. The press, they'll tell you that. The media, they love to say and blame it on Brexit. Even the Bank of England, the Bank of England, they can be... for some reason, everyone trusts the Bank of England, and what they say is the most factual, most realistic outcome of any scenario that they come up with any models or anything, any predictions, when they've been wrong time and time again. Okay? How many actual financial crashes have they prevented, and companies from actually melting down last minute? There's a handful of times. There's not been very many. Here's a video of Alpesh Patel. He owns a hedge fund, and he explains it really well on the BBC.
And the impact that it would be having on inward investment, so talking down the UK economy. Is it declinism or is it realism?
In a way, it's neither, because when you look at the data, as opposed to the narrative, the data surprises even me, given that you would think, oh, well, post-Brexit, and I was a Remainer, surely things are declining. Actually, the realistic side of the data is last year, inward investment, large capital investment into this country was 4.6 billion, more than it was the year before. If you look at jobs created from foreign direct investment, they're up over the last 4 years. If you look at total economic impact of government-involved projects, that's up 82% year on year from last year compared to the year before. So looking at the data, it's quite surprising. There might be pockets where you think, oh, well, we're not making enough cars, etc. But actually, overall, the government-involved projects to bring foreign direct investment into the UK and boost jobs, those numbers are actually increasing, specifically in advanced engineering, biotech, environmental, electronics, life sciences, those areas where we're already leading the world.
Now, if you compare the current outlook for the US compared to the UK, it's dramatic. There's very stark the difference. It's like night and day, the outlook, apparently. But the reason why the UK is suffering so much more right now than, say, the US is because these shocks of inflation are hitting the UK faster than any other country. That's just the pot of luck at the moment. It's just how it is. We had sterling absolutely beaten. It's from the Liz Truss mini budget. It's ever since then, it's not been looking great. Okay? There's nothing truly fundamental that's really changed about the UK as compared to the US for such a negative outlook. And the real issue that's going on is the fact that the US and so many other countries around Europe, they're just lagging behind the UK. They're going to see the big unemployment that's going to come because the Federal Reserve, they're going to have to keep on raising rates. And as these rates rise, they're going to see a bigger impact on unemployment. And the US job reports, a lot of these reports actually lag behind by a few months. So I'd start to give it a good few more months from now, and you'll really start to see unemployment in the US start to creep up and the outlook for the US start to decrease. Because I'm telling you, the outlook today has even started to change. The US inflation figures went up by 0.5. The expectations were as high as 0.2. So inflation is starting to creep back up in the US. Everyone thought it's calming down. US inflation is going to start to go down. They're hoping to get it down to 5% by the end of the year, or middle of the year at least. So things are starting to turn for them, and you'll really start to see the difference towards summer when these unemployment figures start to rise massively and the dollar will turn big time. Proof of this can be seen today in the markets. The pound rose massively against the US dollar when they saw the CPI figures come through, because at the moment everyone's looking at the UK saying, oh, it looks so gloomy there, whereas every other country seems to be far more optimistic. It's just the fact that these figures and this storm that's coming towards the US has already arrived in the UK. It's like in 2008 with the banks, when in 2007 we had Northern Rock in the UK absolutely thundering, just crash, and it didn't really hit the US housing market straight away. It took the following year in September for the US to fully melt down. So currently the UK is experiencing consumer credit falling massively. With credit tightening, that means house prices are falling, with the most recent figures suggesting that house prices have fallen over £12,000. And mortgage approvals are falling, which is going to hurt the housing sector massively. Don't expect this to just be a UK problem. This is the kind of stuff that's going to start to happen in the US, as well as UK retail sales have been falling for the last 9 months in a row. Basically, what this suggests is that UK disposable income has been falling and people don't have the savings. And that's the big issue, is the fact that people do not have the savings, which all ties into the fact that we've got fractional reserve banking and all this sort of stuff, and the QE that basically all encourages people to spend money that they don't have and get loans that they don't have by expanding the money supply, which means for situations like this makes companies default and people to declare bankrupt. People just don't have the savings to pay off their debts. So turning our attention to the main part, the part about investments and what investments you should make in the current market. So if we look at the current market, we can clearly see that there is some levels of optimism in the US, and that's what we're going to be predominantly focusing on in this video, the US equities more specifically. I currently have other investments outside of the US, but in this video we are just going to specifically be talking about current US equities that I am interested in purchasing, and my thesis as to why I believe they're a good buy. Now, this first company, it might come as a bit of a surprise to a lot of people, but I'm actually looking into Meta, formerly known as Facebook, right? So, with Meta, the main reason I think they're a buy is because of the futuristic technology and their VR system that they're going to be focusing predominantly. And people might say, oh, they're already overvalued. There's so much hype behind them already. Well, I was skeptical at first as well until I really looked into it and what they're doing. And I've seen many videos now of this technology that they're going to be using, and it's just the beginning. And I see a massive future for this technology and its real life purpose for the workplace, for entertainment, for video games, so many different aspects. I feel like this could take over the space in the same way when the iPhone came out, that completely changed mobile phones. I feel like this could do the same for workplace and video games. And even just like social media, for example, I feel like there could be some sort of VR, AR sort of social media platform implemented. But I'm not too optimistic on that. I'm more focused on their ability to do things for the workplace and for video games. And Facebook are going hard with these acquisitions they're making in regard to VR companies, all these different startups they are purchasing to help build their company around. And not only that, you're also buying WhatsApp, Instagram, Facebook. This Meta is such a strong fundamental aspect to the company that there's no way that you're putting it all into this big risk behind the potential VR that's going to come. Additionally, Meta doesn't have all of those issues surrounding them that they had 3-4 years ago with the US government on their backs. They haven't got that now, so I feel like there's less risk associated with them as compared to someone like Google, where Google is being hunted down currently by the US government. The focus has gone away from Meta and it's gone over to Google. Now yes, revenues are down. However, this is because they're putting more focus and more of their energy and resources into these VR, AR system. And Mark Zuckerberg strongly believes that this is the future of the company. And of course, it is a bit of a gamble, but from what I've seen, I believe it could be incredibly successful. I see his vision, and his vision is going to make a lot of money. You know, they've cut staff in different areas. They're really focused on cost cutting at the moment, like a lot of companies, but this is strong planning from the company and the board of directors. And when you've got a board of directors and a CEO who believes in their vision, let's just say it's not a bad thing. Now, if we look closely, now reading into this acquisition. They state a California judge is allowing Meta to close its acquisition of the virtual reality fitness startup. Now, this is big because this just goes to show one example of what can be used with this technology, and it could completely alter the way people work out. People may not even need to go to a physical gym, which could save them hundreds of dollars a year on memberships. I mean, think about the type of people this will benefit. Alone, just this technology, they could have people who don't have the time to actually go to a physical gym, 20-30 minute walk away, or they've got to drive and they don't want to have to drive somewhere that's 15-20 minutes and it's like 6 or 7 o'clock in the afternoon, it's rush hour traffic, and they just know it's going to take too much time out of their day, when they could just get home, be in a comfortable environment and work out there and then. And who knows what kind of additional benefit this could have through fitness coaches that are all virtual, and these coaches earn money through this program. I mean, the options are endless. Right, so the second company I'm looking at in buying this month is Amazon. Now, starting off with the new leadership, Andy Jassy, right? He's the new CEO. He's taken over from Jeff Bezos, right? Bezos, bald-headed Bezos, right? He's taken over from him. And many people are saying this situation is very similar to the way in which Steve Jobs, when he left, and Tim Cook took over, right? The transition's very similar to that, because Tim Cook took the company and grew it massively in terms of their software, and not only just their revenues, but it became more focused on the ecosystem. And Andy Jassy could do something similar to that in regard to Amazon Web Services, which of course everyone knows it's Amazon's most profitable form, is Amazon's most profitable area, right? But not only to do with the leadership, I'm also looking at the price chart, and in the last 24 months, Amazon has gone incredibly high and now incredibly low in terms of valuation. Okay? I think where Amazon is going to be as compared to what it is right now, I think it is incredibly undervalued, and I'm going to take advantage of this as soon as possible.